Welcome to Moving Mom and Downsizing Dad, the podcast that prepares you for one of life's toughest yet inevitable moments, stepping in when your parents need you most. Hosted by Spade, a senior real estate specialist with Keller Williams Realty. We'll dive deep into more than just moving. We're talking smart financial planning, making tough decisions with confidence, and strategies to avoid being caught in crisis mode. Join us for real stories, expert insights, and actionable steps to stay ahead of the curve. Now, here's your host, Spade.
And welcome back, everybody, to Moving Mom and Downsizing Dad, the podcast where we help Gen Xers navigate life and our aging parents. I'm your host, Spade at Keller Williams Realty, right here in San Diego. And today we are talking to Lacy Italiano. She's an enrolled agent and is the president and CEO of Italiano Tax Solutions. It's a firm established in 2009. And as an IRS enrolled agent and a fellow of the National Tax Practice Institute, Lacy brings over a decade of experience in providing comprehensive tax strategies tailored to meet the unique needs of seniors. Now, her expertise encompasses tax preparation, planning, compliance, and representation before tax authorities. Lacy is dedicated to helping seniors navigate the complexities of tax laws, ensuring that they maximize their tax efficiency and minimize liabilities during significant life transitions, such as downsizing or selling your property. Now, her proactive approach and commitment to client satisfaction have made her a trusted advisor for many individuals seeking clarity and confidence in their tax matters. Lacy, welcome to Moving Mom and Downsizing Dad.
Hi, Chris. Thank you for having me. This is so exciting. This is long overdue. I'm really happy you're doing this.
Thank you. Yeah, I'm super excited too. It's started to become a passion project. And so I'm super excited to be doing this. So let's just dive in and get started it is tax season right now. So I do appreciate you being here during tax season. I mean, it's got to be starting to get busy for you.
It's just starting. I think there's been a little bit of delay with docs this year because there's always some type of a delay. So We're just starting to, get a good flow coming in. So.
Yeah, I literally just got all the stuff I needed to send to mine today. Or last night. I just checked my mail and the last little bit was there. But let's just get going. So what are some of the primary tax considerations for seniors selling their primary residence?
Well, so the biggest one we all know of is capital gains.
Mm-hmm.
Most seniors, provided they've been lucky and or done well, they don't necessarily have mortgages or they have very low mortgages. And if they're here in San Diego or in California, we all know how much property has appreciated.
Yep.
So more than likely they're going to face some capital gains. And the other thing that can end up impacting is their Social Security, Medicare benefits in the year that they do choose to sell. So those are some things that they really need to make sure that they're working with professionals that can help them plan for those things.
That's important. So can you explain the capital gains tax exclusion for homeowners over 55 and what does that look like? How does that work?
So the over 55 rule was actually done away with in 1997 and it was replaced with Section 121. So it does not apply just to seniors. Anybody can get the primary residence exclusion, and it's $250,000 single head of household, married filing separate, or it's $500,000 for married filing joint. But it's not exclusive to seniors over 55. It's actually open to any homeowners, provided it was their primary residence and they lived in it for 2 out of the last 5 years.
Okay, I think what you said was very important because I think some married couples who are married but filing separately, you only get that $250,000 exclusion, correct?
But they could each get it.
They could each get the $250,000. Okay, very good. Because we got to make sure that that's clear for people. So, are there any recent changes to the tax laws that seniors should be aware of when selling their home?
As of right now, there has not been any major tax law changes. The one thing that they want to be sure that they just continue to keep their eye on is the capital gains tax rates, which have not been changed much since 2018, and any of the proposed adjustments in tax brackets.
Okay. Okay. So let's talk about mistakes. What are some common mistakes seniors make when selling their primary residence in terms of taxes?
The biggest, I don't want to say it's a mistake, but the biggest thing that they might not be aware of is tracking their improvements. I mean, we're talking about people that have potentially lived in a house for 30, 40 years and have been doing things all along the way, but not knowing that those improvements to the house increase their basis, which then at the time of sale reduces the tax, the capital gains tax.
So it would probably be a good idea. I'm just throwing this idea out there that when somebody buys a house, they keep a binder and then they just get those plastic sheets and stick all those receipts in there. And then that way, when they go to sell, they give that to their tax provider.
Yes, absolutely. I also am recommending now, and I know with the older population, tech is not always easy for them, but I have clients in their 90s that do great on my client portal and have no problem with technology. And or they have family members or friends that can help. But we all know that receipts and stuff fade after time. So I would like to see more people scanning in their documentation. So if there's a flood, a fire, they misplace them in a move, there's a digital footprint to that. There's a digital record.
That's a good idea. And you can even do that on your phone and your iPad. There's apps that you can just take a picture and it'll PDF something for you. And you just, put that in there. And that's a good idea. So how can seniors prepare financially for the tax implications of selling their long-term home?
So they need to review what their cost basis is. And cost basis is what they purchased it for.
Mm-hmm.
And then plus improvements they've made over the time that they've owned the home.
Okay.
And that's, the more they have to add to that cost basis, provided they, are like a lot of seniors we know that maybe bought the house for $70,000 back in the 70s.
Yep.
And now it's looking like they could potentially sell it for over $1 million.
Yep.
The biggest thing that's going to help them is to come up with as much of the improvement documentation as they possibly can.
Yeah, so if you do need that main sewer line replaced, it's probably a good idea because those are $30,000-$40,000.
They are. Yep, I was just talking. And roofs aren't cheap these days either. You're looking at about $20,000 to replace a roof.
Yeah, no, exactly. So what you're saying is it's any improvement that they've made to the house, make sure you keep a record of that and give it to your tax professional.
Yes. Yep, because that adds to their original cost basis. And the other thing that it might be hard to find is closing statement from when they purchased it, because those commissions and fees that are on there also increase the basis. But I don't think I've ever seen a closing statement from the 60s, 70s, or even the 80s. I think the 90s is the earliest I've had somebody provide. So it's not critical if they don't have that, and the fees were probably much lower then, and they may not have paid commissions if they were the buyer. So
correct.
What they're losing out on the purchase might not be significant enough to create stress.
Yeah, exactly. So let's talk about how I already asked you that one. Okay, scratch that. Let's go on to the next one. Now, if a senior wants to use a 1031 exchange, what are the key steps to qualify and how does it benefit them? So we've got some seniors who maybe they live in the front house and rent out 3, or over the years they've accumulated some wealth through real estate. What does that look like for a 1031 for them?
So the first thing is a 1031 has to be an investment property.
Mm-hmm.
So let's go to the scenario where you're talking, they have a 2-on-1 and they're renting part, but the front house essentially is their primary residence. They can 1031 exchange that and defer the gain from the rental portion of the property, and then they would pay a reduced rate because they're only doing it, let's say it's a 50-50 split.
Right.
But they will still have to acknowledge the gain that is attributable to their primary residence and 1031 the rental. And I have had that happen. I had it with a 4-plex, and they lived in 25%, and the rest was 1031 exchange to other properties. So they only ended up having to realize gain on 25% of that property, and the rest was deferred into another investment property.
Yeah, and that's what we call a split exchange. So you can exchange it we had Brandon Burns. He is a 1031 expert, and so just for the listeners, if you didn't catch that podcast, that's what we call a split exchange. So you just take the value of what the rental properties would be, and that's what you have to purchase at equal to or greater than, right?
Right. Correct.
Yeah. So it's possible.
I'm not sure if you discussed with the 1031 exchange the days, the deadlines that you have to meet.
Yes, there are deadlines. Yeah. Do you want to go over those?
Yep. 45 days, you have to identify a replacement property. And within 180 days, you have to complete the exchange. And sometimes in markets like ours in San Diego, that can be very difficult.
Exactly. So the plan for that is if you're thinking that you want to sell your income property, what we do is we put a plan together before your house even goes on the market, before your rental property goes on. And we just kind of start eyeballing the market and see what's going on. So we kind of pad it with an extra 45 days. We can't adjust what the government says your time frame is, but we can just play with it before we put your house on the market. And if you identify something, then all the better, right?
Absolutely. And this is why it's critical to work with qualified professionals. Make sure you have a real estate agent such as Chris Spade, who knows these types of things in and out. Make sure that they are specialists. I hate to use the word specialist, but that they're well versed in these types of transactions, and always have a qualified intermediary 1031 exchange broker. Because I have had a client who did not successfully do the 1031 exchange. It did not go through properly, and he ended up having to recognize gain on his property.
And that's a big check to have to write out.
Yes.
Yeah. So on an investment property, let's just talk about that for a second. Let's say they miss the deadline or they just can't find anything they want. What does that tax implication look like on an investment?
Well, of course, it's going to be dependent upon, the income bracket that they're in and the gain on the property. They will have depreciation recapture, and then, they don't really have a lot to add to the basis like they would with a primary residence, because
Right.
they've been deducting that as rental expenses throughout the years.
Correct.
So they will have to recognize the gain on the sale. They will not get the exclusion because it's not a primary residence.
Mm-hmm.
And they will have depreciation recapture.
Okay. Excellent. Are there any? We talked about that. Let's switch gears back to primary residence. So, how does selling a primary residence versus a second home or investment property differ in terms of taxes?
Well, with a primary residence, if you meet the 2 out of 5, you get to use the 121 exclusion. So it's the 250 single, married filing separate, had a household, or 500 married filing jointly.
Okay, so let's back up for just 1 second. So if, let's say, somebody lives in their home as a primary residence and then they move out, and let's say they move into a community, whether that's an assisted living community or they buy in a 55 plus community, and then they've lived there 3 years, but then they decide to sell their primary residence. Can they take the capital gains and not get hit with capital gains tax?
Well, they'll get the exclusion if they've lived in it for 2 out of the last 5 years, and it does not have to be consecutive.
Okay, perfect. Because that's important for people to know as well.
Right. And, again, if we're talking California, San Diego real estate, depending upon the basis and the value it sells for, the exclusion may not be enough to cover. So they may still end up having to pay capital gains, but it will help greatly reduce that.
So, what types of all right, let's start that over. So what type of tax records should seniors keep to minimize their tax liability when selling their home? You've talked about receipts and stuff. Is there anything else they should be keeping?
Well, in terms of a primary residence, they want to keep their home improvement receipts, contracts. If they hire, let's say they redid their kitchen, they've redone bathrooms. I'm sure if they have a contractor, they've got a contract. As much of that documentation as you can keep, you want to keep that because it adds to your basis. If you have an investment property, you want to keep pretty much every tax return that you have that property on, because
Okay.
it's going to help track basis, it's going to help track the depreciation, expenses that have been taken in the past. So if you have, I always tell people, 7 years, you can start getting rid of taxes unless you own investment properties or have stocks. Those are ones that you should keep indefinitely until you dispose of those assets.
That's interesting. I did not know that. I didn't know it was that important to keep those tax returns because I've always, just kept them for like 7 years. I can't wait to just trash them because, now I get everything on a flash drive, so it's easy.
Right. Yeah.
Yeah. So I guess it's easier to save than it just collects, in the closet or something, which is what they used to do.
Exactly. And you can only get copies of tax returns back 10 years from the IRS too. So if you need something farther back and you don't have it and you're looking for a basis or the cost basis of a stock potentially you've had for years and years and years, it can be a saving grace to have those prior returns.
Excellent. Well, that's good advice. So, oh, here's another question that is, let's start this over. Here is a question that I've gotten from other people that I know that you can answer. Can seniors who sell their home move into an assisted living and deduct any of those related expenses?
It will depend on the level of care they're receiving in the assisted living facility. So as we know, a lot of these have levels. They can go from independent to assisted and even into memory care.
Right.
So just rent, typically not. If it's an independent living or they're in assisted living, but really all they're getting is maybe some management on their medication, but they can feed themselves, dress themselves, do their own cooking, shopping, the ADLs of living, then only the portion attributable to medical care would be deductible. So if they
Okay.
move into independent living and it's just paying rent and they're going along kind of completely independent, that is not going to be deductible. But if they're in the assisted living side where they're getting some type of level of medical care, then that will. And then once somebody potentially goes into full care and or memory care, those expenses are deductible.
Interesting. That was another thing I did not know, and I'm sure a lot of people don't know. See, this is why these conversations are so important, and to know these things ahead of time, because there's so many, I like to think I'm pretty smart, but these are things I didn't even have answers to. So how does downsizing to a smaller home or renting affect a senior's tax situation? So we just talked briefly, like going from a primary to an apartment. That's what my grandma did. She went from selling her home and then she was like, nope, I don't want the responsibility. And she moved into a rental situation. What kind of implications does that have?
Well, it really depends. If we're talking about our seniors that had a relatively low loan at the time that they transitioned, or they had no loan and they probably had Prop 13 tax rate, and so they're paying really reduced property taxes, probably don't have mortgage interest or very much, they're probably not going to lose a benefit because they're already taking the standard. Back in 2018 with the Tax Cuts and Jobs Act, we all know exemptions went away, the standard deductions got basically doubled, and then they go up every year a little bit, and then seniors get an additional bump. So most of my seniors that have owned their home for a long time, have the low property taxes and little to no mortgage, are not really losing any tax breaks by downsizing. What they are gaining is not having to keep up on the repairs and maintenance.
Yeah, which is a big deal. That can be a very big deal, especially if you've got family that lives in another state, because so many of us here in California, everybody's moving because it's so expensive. So most seniors' kids have moved to much cheaper places like Arizona or Texas or wherever. Yeah.
And another thing to think about is if they don't have family nearby, they could be susceptible to being taken advantage of in a situation where something comes up at the house. And it's sad to say it happens more often than not. I did have a client several years ago. She was in her late 90s. This was right before she passed away. There was a plumbing issue at her house, and we believe that she was kind of taken advantage. They charged her well over $30,000 for the plumbing. Nobody knows if it was really necessary. And then unfortunately she passed away shortly after that. So those are things to think about, that they're getting referrals from people that they trust, and again, having conversations with the people closest to them so that they know what's going on. Have another person there with you when you get the estimates, when the people come by. We don't want to leave our seniors vulnerable, having random people coming by giving estimates. They know they're going to be alone, vulnerable. So these are all things to kind of think about. And then you teeter on that line of giving them that information, but not wanting to create anxiety for them and make them nervous about doing anything at all.
Right. Exactly. Are there any tax credits or deductions that seniors, I'm going to start that over. Are there any tax credits or deductions that seniors might miss out on when selling their property?
Other than just the missed improvements, that's the biggest thing, and it doesn't even just apply to seniors, is people just don't really know that they should be keeping track of the improvements that they're making to their primary residence throughout the years that they own it, because it does give them a benefit in the event they want to sell. In fact, my own mom just texted me the other day. She put up a new vinyl fence in the backyard. She goes, "Can I deduct that on my taxes?" I said, "No, but you have to keep the records in case in the event you ever want to sell."
Yeah.
So I get that question a lot from people that are like, "I did XYZ to my primary residence. Can I write that off?" Nope, but you need to keep it for your records later on should you decide to sell. And some people will automatically, "I'm never going to sell." You don't always know what's going to happen on later down the road. So it's better to be prepared, safe, rather than sorry later on.
Yeah, I get a lot of people telling me they're going to go out of their property feet first. And I just tell them, you know what, just put it in your trust that I'm just going to sell the house when you're gone.
Yeah.
And there are some people that do, they're there and they do get carried up feet first, right? But you're 100% right, because we never know what's going to happen, and our circumstances can change from one day to the next.
Yeah, absolutely. I mean, you just never know what's going to happen, that it may shift and you may need to be in a memory care and or more of an assisted living facility. And sometimes keeping the house is not an option. Although if they're able to and they want to pass wealth off to their children, keeping the house and doing it via a trust is going to reduce and basically wipe out capital gains tax, because the beneficiaries get a step up in basis as of right now.
Right now. Yeah, that could all go away, but as of today, it's there.
That's right.
Let's talk about how can seniors work with an enrolled agent to maximize tax savings during the home sale? Because I always advise people, especially my senior clients, which I'm really starting to work a lot more with, as we're getting their house to get ready to put on the market. I almost feel like sometimes I go into like a 2 or 3 step listing process, because I want them to go, okay, you should talk to your tax professional first about this, and then, the reverse mortgage specialist about this. And then, that's part 1, right? And then we come back and we've got part 1 done. So what is it? What are some of the questions they should be asking you when they meet with you before they even decide to sign a listing agreement?
How it's going to impact them. And provided I'm their tax person. So if somebody came to me, and I actually had 2 of these scenarios last year where the people had not filed for years because all they had was Social Security. And I think one had inherited a property and then many, many years ago, and the other one had just owned it for several years. And they came to me and they're like, "But I haven't filed in years. My only income is Social Security." So I was able to talk to them. I was able to work with the broker to get an estimated settlement statement or disclosure statement. They do estimated ones. I can also work with if the real estate agent's like, "We're thinking about listing it for this amount." And I can do an estimate based on that. And if their only income is Social Security, that makes it really easy. If they have other income, pensions, investments, other maybe rental properties, then I would have them provide me a copy of their prior year return, and I would get the figures, whether that's just a potential sale price or an estimated closing statement, and I can actually run an estimate. And oftentimes, I'm sure you're aware, in California, when people are selling any type of property, you have to do a 593 through the escrow process. Back in the day, because of the 121 exclusion, it was just common course for people to check that, it was a primary residence. They don't have to pay tax on it because they were going to get that exclusion. But again, in our market here locally and in California in general, a lot of people now are seeing gains even after the exclusion. So it's not just to check the box and then do no planning, because more than likely you're going to owe tax at the end of the year, and the government wants it up front. So that's why California takes it from the escrow process. If you fill out that 593 correctly and report a potential gain, escrow then sends a check to the state of California to satisfy that estimated tax liability. You should work with an enrolled agent or a CPA trusted tax professional to do the same thing for you for the IRS. So when escrow closes and money hits the bank, you can turn around and write a check to the IRS as well.
And that's just very good sound advice, because that way it's already gone. And if you owe a little bit more, or maybe you'll get a return, who knows, like after your taxes are done. But it's just, when I go, that's what I do when I divide up commission checks. I go, oh, I got a commission check for this much. I know, I will probably have to pay this. And I'm always sending stuff to the IRS.
Well, they probably love you.
Yeah. I don't necessarily love them, but
and I'll just say, I'm just the interpreter. I'm not necessarily a huge fan of the IRS myself. In fact, they make my job very difficult. But my job is not, I don't work for the IRS. My license is through the Department of Treasury, but I'm not an IRS employee. My job is to help people maximize tax reduction and to follow the law, kind of in that gray area. But I am highly ethical in how I approach things. I try to get a feel for the client's tolerance level, and I'm 100% upfront about risks. And I have some clients that want to take no risks, and then I've got other clients that will take that risk, and then you've got everybody in between. And so I just make sure that I am very upfront and tell them this is the worst case scenario potential that could happen. But it's always good to work with qualified professionals, and it's refreshing to hear you say you've got this 3-step process, because so often I do get people after the fact. The house has been sold, the year is over, I'm now doing their tax return, and I've got to deliver some really bad news because somebody just checked that box. It was a primary residence, and the exclusion doesn't cover all of it, or there was a rental business component to it that increased the taxes. And so it's always good to consult with. And if a professional wants to charge you for a planner, it's worth every dollar.
Oh yeah, 100%. I agree. 100%. Let's, last question. What should seniors know about gifting property to family members versus selling it outright? This is a good question.
It really is a good question, because I've seen this happen both sides. I've had a few that have come up and mom just put me on the property before she passed away. You lose your step up in basis. And what step up in basis is fair market value on the date of death of the decedent. So if you get put on the deed prior to your parent passing and the house is worth $1 million, but they only paid $100,000 for it, your basis is $100,000. So you now, in the event you want to sell it, have capital gains. If you do not get put on title and it goes through and passes through a trust or even probate, because probates get step up in basis as well, the beneficiary gets that value on date of death, which almost always closes that capital gains. I actually see it more turn into a loss after the commissions on an estate or trust tax return than I see them have to claim any gain. So I never recommend that parents put their kids on the house because they don't want to go and spend the money to get a trust, because that will hurt the beneficiary later on. But gifting, if they want to kind of bring down some of their estate and gifting cash, they can do up to $18,000. Well, that was the limit for 2024. I believe $19,000 is 2025. It goes up a little bit every year. They can gift that much each year without having to file a gift tax return. And let's say you have a senior who's got a daughter who's married and they have 2 kids. She could reduce some of her estate by gifting each one of those people under the annual exclusion. So for 2025, $19,000 before she would ever have to file a gift tax return.
Interesting. And
Oh,
go ahead.
In the event that they do gift a property, because I have seen that happen, that will always trigger a gift tax return filing. And sometimes people get thrown off by that because they think they're going to have to pay tax. If they're under the 13, I think it's about 13 million right now is the the whole exclusion. They won't have to pay tax on that gift tax return. It's really just a reporting. And then the person you gift to, they don't pay tax on the gift. It's just a reporting return. So what they actually incur is the extra cost of having to file an extra tax return.
Yeah, which is not horrible.
It's not.
One thing we should point out is you talked about a trust and a house being in a trust. Trusts are not that expensive. In fact, we're going to have our trust attorney on in a couple of weeks. They're worth every penny. I mean, they're less than probably $3,000, and you can get people who just do trusts that are much cheaper than that. But working with an attorney, it's probably one of the best things you can do to, protect your assets down the road.
It avoids probate, and probate is open to the public. It has to go through a court process. It takes a little bit longer, and then there's an attorney that's going to get paid, and it's a graduated percentage based on the value of the assets. Which it can be good because they can't overcharge either.
Correct.
It's all monitored by the courts as to what gets paid. And then if a family member or friend is not able to be the administrator of that probate and work side by side with the attorney, then you would have to hire a professional fiduciary, which we'll talk about on the next episode, to run that probate, and then they also get that same commission that the attorney does.
Yep.
So it takes time and it takes extra money out of the hands of the beneficiary.
Yep, exactly. Lacy, is there anything I didn't ask you about taxes that you want to reiterate that I should have asked you? Is there anything I missed?
The only one thing I was kind of thinking of when we were talking about what they could deduct for assisted living is one thing that comes up quite a bit when seniors are still in their home but need care and the family hires outside caregivers. There is a thing for household employees and or potentially having to 1099 these caregivers. And I've seen seniors be put in some really compromising positions when this comes out, because they don't know that if they have somebody full time in their house taking care of them, that they then are considered a household employee, where you would have to file a Schedule H in the senior's tax return. Social Security, Medicare would have to be paid on behalf of that household employee. And or if they're an independent person coming in, you should be 1099ing them if you want to take that as a medical deduction. And I actually had a client several years ago that had a caregiver that was there pretty much, I wouldn't say 24/7, but he was there 7 days a week for a good part of the day. My client very much trusted this person. He was comfortable with this person. It was his absolute primary caregiver. And he was getting sicker and sicker. And he sold some properties himself. They were investment properties. And of course, he had capital gains in taxes. And we needed the deduction. And when I went to this caregiver and said, we either need to put you on a W-2 or we need to 1099 you because he needs these deductions, after he willingly signed the W-9 form for me, but after I left, he went to the client and said, if you do this, I'm going to leave you. And that terrified my client because this was the only person that they trusted for the type of care that he needed at the time. Mm-hmm. And so that puts the senior in a really hard position once they've already begun trusting somebody.
Yeah.
So it's better to have these conversations up front before you hire them, so you can make sure everybody's on the same page when it comes to that, instead of getting to the end of the year and going, well, we got to give you a 1099.
Yep.
And then the person doesn't want to do that because they don't want to claim the income for one reason or another, and it puts the senior in a bad spot.
That is a very good point, and that is a very good conversation to have way in the beginning before you hire anybody. Would that still apply if you were hiring somebody through an agency, or would that be you just pay the agency directly?
the agency should be handling all of that.
Okay, so this only applies if I come into your house, you hire me, and you give me the 1099, or you are giving me a paycheck every 2 weeks or a month, right?
Correct.
Okay.
So the household employee, and another example that is like a nanny, somebody who's in there full time, they're there pretty much 9 to 5, or maybe they even live there, and you pay them over $2,200. I think that's the limit for this year. You have to do household employee taxes. They're special, and so you can hire an agency that will do them for you, or you can talk to an enrolled agent or CPA that knows about what they deem nanny taxes. But it also applies to caregivers in home full time. But oftentimes we see seniors that are like, I just need somebody to come in and help me maybe do laundry or pick up or make a couple of meals. And so somebody is independent. Maybe they got referred to, oh, my friend does that. And the person comes in and maybe they do some grocery shopping. They cook a couple of light meals. They help with laundry, but they're not there full time. Then you have maybe a potential 1099 situation. Agencies, I do recommend, but you have to make sure they're reputable.
Yep. And that's a whole other conversation.
It is.
Right on. All right. Lacy Italiano, thank you so much. I'm bringing her back in a new episode coming up here shortly. And we're going to talk about being a licensed fiduciary. But for right now, Lacy, thank you so much for joining us on Moving Mom and Downsizing Dad.
Thank you for having me.
Awesome. And for the rest of you, I look forward to catching you on the next one. Stay tuned. Keep subscribing to the podcast and comment below. I truly appreciate it. Thanks so much. Bye-bye.